Today, we're going to be looking at the TWN or Taiwan ETF fund and comparing it to other funds to measure performance. So sit back, relax, and remember to watch till the end because there'll be a bonus strategy on how to take advantage of the Taiwan ETF's volatility. In this analysis, we'll be focusing on two particular ETFs, the Fidelity 500 Index and the Taiwan Fund. The Fidelity 500 Index ETF aims to replicate the performance of the S&P 500, a broad market index in the United States. On the other hand, the Taiwan Fund is a country-focused ETF that aims to capture the performance of the Taiwanese market. So without further ado, let's dive into the data to understand how these two portfolios have performed over time. We now turn to the Taiwan Fund, a collection of investments focusing on Taiwan's stock market. This ETF gives a remarkable performance. The initial balance of $10,000 has grown to a considerable $48,792. This growth signifies a compound annual growth rate, or CAGR, of 13.81%, reflecting its potential. Although the fund has higher risk and volatility, it can also provide high returns. The fund's best year recorded growth of 58.05%, while the worst year had a decline of 38.54%. The most significant drop in value was 50.04%, demonstrating the fund's volatility. Despite this, the fund has potential for high returns. The costs and dividends also need discussion. The operational costs of managing the fund was 1.4%. The dividends was 1.08%. Risks and volatility considered, Taiwan Fund has still managed to yield robust returns over the years. Now let's shift our focus to the Fidelity 500 Index, a portfolio that mirrors the performance of the S&P 500. Examining the performance of the Fidelity 500 Index reveals some impressive figures. Beginning with a starting balance of $10,000, the portfolio thrived, ending with a striking balance of $52,820. Translates to an annual growth rate of 14.55%, showcasing the portfolio's robust growth potential. XRSIX had a maximum drawdown of negative 23.88%. Turning our attention to costs, we will be discussing the Fidelity 500 Index's expense ratio and dividend yield next. So what's the bottom line? The Fidelity 500 Index had a dividend yield of 1.31%. The expense ratio of the Fidelity 500 Index Fund was 0.015%. It has shown consistent and steady returns over time for a good price. Now that we've examined both ETFs, how do they compare? Let's dive right in. Both the Fidelity 500 Index and the Taiwan Fund started with an initial balance of $10,000. After some time, the Fidelity 500 Index ballooned to a final balance of $52,820, while the Taiwan Fund grew to $48,792. Looking at the compound annual growth rate, the Fidelity 500 Index had a CAGR of 14.55%, slightly edging out the Taiwan Fund, which had a CAGR of 13.81%. Now let's talk about volatility. The standard deviation, a measure of risk, for the Fidelity 500 Index was 14.32%, significantly lower than the Taiwan Fund's 22.09%. The Taiwan Fund had a higher return in its best year, but also suffered a greater loss in its worst year. The maximum drawdown or peak-to-trough decline was also quite different. The Fidelity 500 Index saw a maximum drawdown of negative 23.88%. The Taiwan Fund, however, experienced a much steeper drawdown of negative 50.04%. In terms of the expense ratio, the Taiwan Fund's ratio was significantly higher at 1.4% compared to the Fidelity 500 Index's minuscule 0.015%. Similarly, the Fidelity 500 Index also had a higher dividend yield. Here is the strategy that could take advantage of the Taiwan Fund's volatility: dollar cost averaging. By investing in initial $10,000 and then contributing $2,500 every single month, the Taiwan Fund balloons to around $1,223,964 versus if you invested in the alternative, only growing to $1,040,327, meaning actually outperforms the Fidelity 500 index in terms of final balance and compound annual growth rate. However, the Fidelity 500 index has a higher time-weighted rate of return. But here is an extra bonus. For the amount you're paying in expense ratio, you could be acquiring a higher performing fund like SMH, FSLX, or even TQQQ if you wanted to go for a maximum growth, or if you wanted to keep the similar amount of downside volatility protection. You could go with VGT, FTSE, or QQQM for lower expense ratios and similar downside drawdowns over the same time periods. Subscribe for more videos like this and check out this video on FXAI.